All. Please confirm you can hear me clearly.
We can hear you, sir.
Can hear you, sir.
Can hear you.
All right. Thank you. You can mute. Tonight, we are starting our PM class, Performance Management. And our first topic tonight is cost estimation. But before we go to the topic, let's do an overview. Before we go to the topic, cost estimation and analysis, let us do an overview of performance management. What are the expectations? What are the skills required? If you refer to your syllabus, the ICAN syllabus, I can make it very clear. Performance management are seated on three areas of accounting. Performance management are drawn from three aspects of accounting. One is cost accounting. For you to be able to write performance management, you must have a knowledge of cost accounting. Number two is management accounting. For you to be able to write performance management very well, you must understand management accounting principles and techniques. Then lastly, you must understand quantitative analysis. If you refer to your syllabus, I can say performance management is seated on three areas: cost accounting, management accounting, and quantitative techniques. These three knowledge are needed for you to be able to write performance management paper. I will say this, particularly given the fact that we have a lot to do here. If you look at performance management, that's the management of performance at various levels. Companies are in business to perform services or to perform products. Companies, we are in business to produce products or render service. Your product or service must perform a specific function or functions. If you produce a product, that product must be able to perform some function. If you are rendering services, that service must perform function. So performance management is a broader view, a bigger view of management accounting. Having said this, let us go to the first topic. What is cost estimation? You can define cost estimation as the process of measuring historical cost. It is the measurement of historical cost with a view to helping in the prediction or estimation of likely future costs. I will take that again. Cost estimation. This is the measurement of historical cost. Cost estimation is the measurement of historical cost. Who is asking this question? The class automatically record now. It's not a question, sef. The class automatically record. And please don't say because it's recording, you are not paying attention. Cost estimation can be described as the measurement of historical cost with a view to helping in the prediction or estimation of likely future costs, so as to assist management in planning, controlling, and decision making. Let us break that down. We said cost estimation. You are measuring historical cost. You are measuring your past cost with a view to help you to be able to predict likely future costs. Why do we need to predict likely future costs? Is to help us in planning, is to help management control, is to help decision making. For example, let us take equity professionals. Before the commencement of this diet, commenced, the management of equity met. Prior to this lecture, the management met to discuss plan for November diet. What are the plans for November diet? One of the plans is to provide student study pack. One of the plans is that we might need to prepare a study pack, and possibly we might need to print the study pack. That means we need to have a budget. How much will it cost us if you are to print study pack for the students? As at that time we are having the meeting, We don't know the number of students that we enroll for the class. We are not sure how many students we enroll, but we need to print study pack for students. That means we must have a budget. How much will it cost us if you are to print study pack for the students? We now go back to our historical cost. The cost incurred last year. We now check our accounting, our ledger book. How much do we spend last year to print study pack? Look at it. We are now measuring historical cost with a view to helping us to predict likely future costs, so as to guide management planning, so as to guide management decision making. In other words, historical cost information is evaluated to provide estimates on which to base future cost. Cost estimation is the process of evaluating, the process of analyzing historical cost, so as to provide estimates of the costs we are likely to incur in the future. We have defined cost estimation. You are trying to estimate future cost from your past cost. Historical cost information is analyzed, is evaluated, is reviewed to provide estimates on which to base future cost expectations. All right? We have defined cost estimation. An understanding of cost behavior is a prerequisite for cost estimation. Excuse me, please. I'll take that again. An understanding of cost behavior is a prerequisite for cost estimation. What does that mean? It means for you to be able to estimate cost, you must understand cost behavior. How does the cost behave? So your knowledge of cost behavior is required for cost estimation. What is cost behavior? Cost behavior is the manner or way in which cost respond or cost reacts to changes in activity level. Cost behavior. This is the way, manner in which cost responds to changes in the I'll take that again. I'm going to take that explanation. Cost behavior. This is the manner or the way in which costs respond to changes in the volume of activity. We have three types of cost behavior. We have three types of cost behavior. You have variable cost. Variable cost. These are costs that vary in direct proportion with the volume of production. Variable cost. These are costs that vary in direct proportion with production volume. The more you produce, the more we produce, the more the total variable cost increases. A good example is direct material cost. A good example of variable cost is direct material cost. If you look at material cost, the higher the production volume, the higher the total material cost incurred. The more you produce, the more raw material cost you are going to incur. In that case, material cost is an example of variable cost. Please get me water. We need to make a distinction. Please note, material cost per unit is constant, but total material cost will continue to increase in direct proportion with the volume of production. Please, there is difference between cost per unit and total cost. Material cost is not known as variable cost. So material cost is not known as variable cost. I said material cost is an example of variable cost. There are other variable costs. For a cost to be variable, that cost must vary in direct proportion with the volume of production. The more we produce, the more the total material cost incurred. But please note, material cost per unit will be constant. For example, if you buy one bottle water is 200 naira per bottle. If you buy two, it becomes 400 naira. If you buy three, it becomes 600 naira. The more you consume water, the more the total cost increase. If you buy 10, it becomes 2,000 naira. The more you are taking the bottled water, the more the total cost of water increases. But the cost per bottled water is constant at 200 naira. I hope that point is clear.
Yes,
I
sir.
hope that point is clarified.
Yes, sir.
Please always note, there is difference between cost per unit and total cost. So, for a cost to be variable, that cost will increase in line with the volume of production. All right, number 2, fixed costs. These are costs that do not change regardless of the volume of production. Fixed costs. These are costs that remain fixed in total. The fixed costs. These are costs that remain fixed in total, regardless of the volume of production. The fixed cost is fixed, irrespective of the number of units produced. A good example of fixed cost is rent, your business rent. We pay rent annually. That rent is fixed. If you like, produce 1. If you like, produce 10. If you like, produce 10,000. Your rent is fixed. The rent is not dependent on the volume of production. The rent is not dependent on the volume of production. So when you say fixed costs, these are costs that remain fixed in total, regardless of the volume of production. And now please note, we are not saying that fixed costs will not change. Fixed costs can change. But the change will not be as a result of the volume of production. We are not saying that fixed costs cannot change. Fixed costs can change. Maybe after 2 years, the landlord may increase the rent. Maybe after 5 years, the owner of the shop may increase the rent. But the increase in fixed costs is not as a result of changes in the volume of production. I hope that explanation is well taken.
Yes, sir.
Yes, sir.
Number 3, mixed cost. In between the variable cost and fixed cost, we have mixed cost. These are costs that are partly variable and partly fixed. Your mixed cost, it contains element of variable cost and fixed cost. A good example of mixed cost is your electricity bill. If you look at electricity bill, NEPA will charge you fixed maintenance charge every month. For putting meter in your house, NEPA charge a fixed maintenance for that meter. In addition to that, you now pay for your consumption, the number of units you buy or you use every month. So you are going to have the fixed maintenance charge plus the consumption charge. The fixed maintenance charge is the fixed cost. The consumption is based on the number of units you use. That is the variable. The two will now be added, will now give you total mixed cost. It contains element of fixed cost and variable cost. Trying to take water. All right. We have a cost estimation, behavior, we have our next explanation. Our next explanation, cost estimation techniques. Basically, there are 5 methods that can be used to predict future cost. Basically, there are 5 main methods that can be used to estimate likely future cost. This includes 1, engineering method. Number 1, engineering method. Engineering analysis method. This method, otherwise known as work measurement method, is used to estimate cost. It is used to estimate cost. If it is possible to define the physical inputs required to achieve a specific output, the engineering analysis method is used to estimate cost. If it is possible to define the physical inputs required to produce a specific output. If it is possible to define all the physical to achieve that product, then we can use engineering method. The engineer who is familiar with the technical requirement of the product, the engineer who is familiar with the technical requirements, we estimate the quantity of material needed, the labor hours needed, and the machine hours needed. Thereafter, prices are applied to these physical measures. Thereafter, prices and rates are applied to this physical measure. so as to obtain the cost estimate. Let me assuming you want to manufacture a Samsung. You want to manufacture a Samsung phone. And you are trying to estimate the cost. What will cost you to manufacture this Samsung phone? To do this, you can invite engineer, a telecommunication engineer that knows about phone very well, to tell you what are the inputs required to produce Samsung. If I'm to achieve this Samsung, what materials do I require? Input material. Most likely, the engineer will tell you that you require the battery, the memory size, the screen, the keypad. The engineer will list all the input requirements to produce the Samsung. When you are done, now say, okay, how much will the battery cost me? You are going to attach a cost to battery. How much will the memory size cost? How much will the keypad cost? You are going to put cost to individual physical inputs. If you are doing that, you are doing engineering analysis method. Number 2 method. Accounts analysis method. This method uses the information contained in the ledger accounts. This information is analyzed and categorized into variable cost, fixed cost, or mixed cost. Let me take that again. Accounts analysis method. This method does not use technical information, unlike engineering method. This method uses the information contained in the ledger accounts. This information will be analyzed and categorized into variable cost, fixed cost, and mixed cost based on the personal judgment of the accountants. The account analysis method is based on the personal judgment of the accountants. The method is very easy to use. The accountants, we as accountants, based on our knowledge, we can categorize costs into variable cost, fixed cost, or mixed cost. However, there are some problems associated with this method. The account analysis or the inspection does not always indicate the true nature of the cost. That is, the information contained in the ledger accounts may not give us the true nature of cost. Accounts, by their nature, are summaries. and often contain different transactions. So the method is very subjective. That is number 2 method. Need just 1 minute. Right? Scatter diagrams. The scatter diagram method. This method involves plotting on a graph the total cost for each activity level. This method involves plotting on a graph the total cost for each activity level. The total cost is represented on the vertical axis, the y-axis. The activity levels are recorded on the horizontal axis, the x-axis. A straight line is fitted on the scatter of plotted points. A straight line will be drawn on the scatter of plotted points by visual approximation. Let me summarize this. You are going to create a graph. You are going to draw a graph. You have your y-axis and you have your x-axis. Your y-axis represents your total cost. Your x-axis represents the volume of production. That is the activity level. You now plot volume of production with the total cost. That will now give you plotted points. That will give you plotted points. On your plotted points, you now try to draw a straight line. That straight line is subjective. Using your eyes to look at all the points, you are trying to look for the middle by visual approximation. This method is very unlikely to produce an accurate cost estimation. All right. We have explained the first 3 because they are in your syllabus. But honestly, these first 3, it is very unlikely the examiner will ask you. It is very unlikely that examiner will ask you the first 3. But the last two involve both calculation and theory. So you must pay attention to these last 2. Number 4 method. the high and low method. The high/low method. This method uses the two extreme data points. This method, the high and low method, uses the two extreme data points to determine the values of A. A represents the fixed cost, and B, small letter B, represents the variable cost in the equation y is equal to A plus bx. Let me take that again. The high and low method uses the two extreme data points. What are the two extremes? The highest activity level and the lowest activity level. These are the two extreme data points to determine the value of fixed cost and the value of variable cost per unit from the equation y is equal to A plus bx. This is the equation of the cost function. Y is equal to A plus bx is the equation of the cost function. Your letter y represents total cost. Your small letter a represents total fixed cost. Your small letter b represents variable cost per unit. Your letter x represents volume of production. You can use high and low method to calculate total fixed cost and to calculate variable cost per unit. All right. Conditions for high and low method. For you to use high and low methods to estimate cost, before you can use high and low method for cost estimation, three conditions must be in place. Three conditions. Three conditions must be in place. What are these conditions? Condition number one, there must be activity at the highest level. You must have activity at the highest level and the lowest level. Condition two, the variable cost per unit must be constant at all levels. The variable cost per unit must be constant at all levels. Then condition number three, the total fixed cost must be the same at all levels. These three conditions must be in place before you can talk of high and low method. All right. Steps. The method involves the following step. If you are to use high and low method to estimate cost or to separate cost, if you are to use high and low method, please hold on. All right, sorry for the break. Let's go on. The following steps should be followed. 1. Select the highest activity level, the highest output level, and the corresponding cost. You select the highest activity level and the corresponding cost. The corresponding cost may not be the highest cost. So you are going to pick the highest activity level and the corresponding cost. Your corresponding cost may not be the highest cost. That's step 1. Step 2, select the lowest activity level and the corresponding cost. Step 3, calculate the variable rate per unit. That is the variable cost per unit. This is calculated as differences in cost divided by differences in activity level. That will give you the variable cost per unit. When you get the variable cost per unit, use this to calculate the total variable cost. When you get the variable cost per unit, then use the variable cost per unit to calculate the total variable cost. That becomes number of units produced multiplied by variable cost per unit. That will give you the total variable cost. Number of units produced multiplied by the variable cost per unit. That will give you the total variable cost. Please note, you can either use highest level or lowest level if you are trying to calculate total variable cost. Then the last step, calculate the total fixed cost portion. Your total fixed cost is equal to total cost minus total variable cost. Your total fixed cost is the total cost minus the total variable cost. These are the steps involved. Now, please note, where inflation makes the cost in each period impossible to compare, where inflation makes the cost, the cost in each period difficult to compare. Your cost should be adjusted to the same price level index, to the same price level by means of price level index. I have to explain this. Let me take that statement again. Where inflation makes the cost in each period impossible to compare, cost should be adjusted to the same price level by means of price level index. Let me explain that briefly. If you are trying to compare cost in 2025 with cost in 2024, and the examiner says inflation in 2024, 10%. Inflation in 2025, 30%. The inflation rate is not the same. You cannot compare two costs where the inflation rate is different. In that case, we are going to remove that inflation. We are going to adjust the cost by removing the inflation. To remove the inflation, you are going to use price level index. When we get to question, if there's inflation, we are going to adjust it. One major limitation with this method is that it only considers the two extreme ends. It only considers information at the highest level and information at the lowest level. It assumes that all other levels are not relevant. All right. We now look at regression analysis method. The regression analysis method is a statistical method of estimating cost. The regression analysis method is a statistical method of estimating cost using historical data from a number of previous accounting periods. This method is a method of regressing Y, the independent variable on X, the dependent variables. Your regression analysis method. We use statistical formula to estimate variable cost per unit and total fixed cost. We use statistical formula to estimate the variable cost per unit and the total fixed cost. Your regression analysis method is to achieve two purposes. One is to be able to define the line of best fits. From the observed relationship between cost and volume, we're able to know the appropriate line of best fits. The line of best fits is the line that can be used to forecast cost. Secondly, it tells us how much confidence can be placed on the goodness of the fits of the regression line. If you look at it, let's do an example. You may be asked to text the impact of advertisements on sales volume. You may be asked to text the impact of advertisements on sales volume. That is, if we increase our advertisement costs, will it have impact on our sales volume? You are trying to regress sales dependent variable on advertisement independent variable. The question is, does sales depend on advertisement? A regression analysis can be carried out to test the hypothesis. Look at the statistical formula. Your small letter B, don't forget, that is your variable cost per unit. And the formula is n summation xy minus summation x summation y over n summation s square minus summation s into bracket square. While your small letter a, the fixed cost, is calculated as summation y over n minus B summation X over N. This method, the regression analysis method, is regarded as the best method of estimating cost. The regression analysis method is regarded as the best method of cost estimation because it considered all the observed variables. Unlike high and low method, high and low method only consider the highest activity level and the lowest activity level. But regression analysis method considers all the levels. Your small letter N, number of observations. Your letter Y, dependent variables. That is your total cost. Your letter X, independent variable, volume of production. Your small letter B, variable rate per unit. Your letter A, the total fixed cost. To wrap up this discussion, we look at the conditions for a regression analysis method. For you to talk of linear regression method, it's also called linear regression method. Some conditions must be in place. One of them is there should be an underlying linear relationship between the two variables. Meaning that one variable must be dependent on the other variable. Number two, the historical cost data should be adjusted to a common price level where there's inflation. We have explained that before. Where there's inflation in your question, and you are trying to compare cost in 2025 with cost in 2026, so as to predict cost in 2027. If there's inflation between 2025, 2026, 2027, we must adjust that inflation. The historical data should be representative of current technology, efficiency level, and current operations. Condition 3. As far as possible, historical data should be accurately recorded as far as possible. Your historical data should be accurately recorded so that variable costs are properly matched against the items produced. What we are trying to say is your accounting information should be accurately recorded so that your variable costs are properly matched against items produced or sold, and your fixed costs are properly matched against the time period. Fixed cost is related to time, like your rent for year 1, rent for year 2. Lastly, management should either be confident that conditions which existed in the past will continue into the future. Management should be confident that conditions which existed in the past will continue into the future. Let me explain that briefly. If I'm using 2025 cost information, cost incurred in 2025 or cost incurred in 2026, if I want to use it to predict 2027, I must be sure that the conditions that are in place in 2026 will continue to 2027. For me to be able to use past cost, I must be confident that the conditions that is operated now, 2026, will continue into the future. If conditions are likely to change, then we must make amends or amend the estimate of cost produced by the linear regression analysis to allow for changes, expected changes in the future. Then when you are talking of forecasting, if you are trying to estimate, as with any forecasting process, the amount of data is very important. The larger your data, the lower your errors. All right. We are done with the explanation. We are done with the explanation on cost estimation techniques and principles. Any question, clarification? While we wait for your question, please check your study pack material, page 79, question 2. on the online class, there could be instances where the network may fluctuate. It's possible. It's very possible network is fluctuates. So if network is fluctuating, on my side, I will know. That's why at times I try to go back to what I've explained. Just as the lecturer network can fluctuate, the student network too can equally fluctuate. So if you are in a classroom and you cannot hear, don't wait until the end of the class. Quickly pause the lecturer and let the lecturer be aware that you cannot hear him or her. All right, please refer to page 79, question 2. Ekwa Industries. Let us deal with this question. Please, just 1 minute. Go and check the page.
Sir, which study part, sir?
There's just one study pack now. PM study pack. It's on the group chat. We are doing PM. Abi?
And
The
there's
director shared the study pack today. So if you are on the group chat, you must have the study pack. So go check. Meanwhile, please give me 1 minute. I'll be back. I'll be back in. All right, let's go on with the class. Question number 2, page 90, page 79. I'll read. Ekwa Industries Limited operates 2 factories, one in Apapa, the other in Ikeja. The factory at Apapa is currently the factory of Apapa the factory at Apapa is producing outputs in excess of sales demand, and it will be necessary to reduce output in the next period from the current 90% level of activity, in brackets 11,700 units, to 75% level. The factory at Ikeja is also currently working at 90% level of activity, brackets 8,100 units of a different product. But due to heavy sales demand, it is intended to reduce output to 115%. You are given the following information about cost. Apapa factory, level of activity, 80%, 90%, 100%. We have direct material cost, direct labor cost, production overhead cost, and sales value. Ikeja factory, the activity level 80, 90, 100, 105, and 110%. You have the direct material cost, direct labor cost, production overhead cost, and sales value. Next. You are required prepare a statement to show the expected marginal cost, contribution, and profit for each factory at the proposed level of activity. All right. Before we go to the solution, let us try to explain the question. Eko Akete has two factories. One is located at Apapa. The other is located at Ikeja. Apapa factory is producing output in excess of demand, and management want to reduce the output level in the next period from the current 90% level to 75% level. Management want to reduce output from 90% to 75% at Apapa. The factory at Ikeja is also currently working at 90% level of a different product. But due to heavy sales demand, demand is high at Ikeja. Management is planning to increase output at Ikeja factory to 115% level. You are giving cost information for You are also giving their different activity levels. Let me take that again. You are giving cost information at Apapa factory at the different levels, 80%, 90%. You are also giving cost information at Ikeja factory at different levels from 80% to 110%. You are now asked, to produce a statement to show the expected contribution and expected profit for each factory at the proposed level of activity. That means you are going to produce two statements, one for Apapa at the proposed level of 75%. That statement will show marginal cost, contribution, and profit. When you are done, you now go to Ikeja. You are going to prepare a statement at the proposed level of 115%. That statement will show marginal cost at 115%, contribution at 115%, profit at 115%. We are trying to explain this. If you look at the question, there is nowhere the examiner say estimate cost. For this question, there is nowhere examiner says estimate a particular cost. Use a low method. Examiner says show the expected marginal cost. Now ask yourself, for me to calculate expected marginal cost, I must understand what is marginal cost. What is marginal cost? Yes, somebody talk to us. What is marginal cost?
Marginal cost is cost incurred as a result of producing an extra unit of a company's product.
Oh, that's great. Frances, she said marginal cost is the cost incurred as a result of producing an extra unit. Any other opinion? All right.
Sir, I would also say that when calculating for marginal cost, it doesn't include fixed costs or something.
All right, Ineka, that's great. We can also say that when you are calculating marginal cost, it does not include fixed costs. That's great. There are two perspectives. You can define marginal cost from the perspective of the economist. From economist viewpoints, marginal cost is the additional cost incurred as a result of producing an additional unit. That was Frances' definition. Frances defined from economic viewpoints. Your marginal cost, the additional cost incurred by producing an extra unit of your company's products. Alternatively, marginal cost from accountant viewpoints. From the accountant viewpoint, marginal cost is the addition, the summation of all variable costs. From the accountant's viewpoint, marginal cost is the summation, the addition of all the variable costs. It does not include fixed costs. That is what Ineka is trying to tell us. If you have time, instead of it to be a class, you are fighting yourself on the platform. Now we have explained marginal cost. For this question, we are going to identify all the variable costs. We are now going to sum together. That will now give us our marginal cost. For this particular question, we are going to adopt accountant's viewpoint, the addition of all the variable costs. Now, what is contribution? Somebody talk to me.
Contribution is the state minus variable cost.
Okay, Joshua.
Yes, sir.
Contribution is sales less all the variable costs. That's correct. Your contribution is your sales value minus your marginal cost. Lastly, your profit. Your profit is contribution. Okay. And your Lord, this is a big thing.
Yeah, it's also the profit manufacturer.
Yes, that's great. Your profit is contribution minus your fiscal. We have defined all the variables. We can now go to solution now. Okay. for God's sake. Oh. Forgot to remove all these things. Please, just 1 minute. We can be on the same page. Oh, okay. I couldn't do this today in the office. They just give me like a very few minutes. I should be done. I want to empty this place first. Oh, okay. Okay. No. Okay. All right, let's deal with this. So that we start afresh. So you start with Apapa Factory. Statement of marginal cost, contribution, profit at the proposed activity level, 75%. Now, how do we start? How are you going to start this question? First, you are giving activity level in percentage. Our focus is on Apapa first. You are giving the activity levels in percentage. 80%. Oh, who is this distracting this class? You are giving activity levels in percentage. 80%, 90%, 100%. the first thing you need to do, convert percentage to number of units. Convert percentage to number of units. Examiner says the Apapa factory is producing output in excess of sales demand, and it will be necessary to reduce output in the next period from the current level 90%, in brackets 11,700 units, to 75%. That means currently 90% at Apapa is equal to 11,700 units. We now come to working one. Look at working one. Level of activities in units. Examiner say 90% is equal to 11,700 units. If you want to get 80%, it becomes 80 over 90 multiplied by 11,700. Please work this out. What is the unit at 80%?
10,400.
If you want to get 100, 10,400 units. If you want to get 100, it becomes 100 over 90 multiplied by 11,700. What do you have?
13,000.
13,000.
Oh yeah. Please
13,000.
get your calculator. The proposed level, thank you, 75%. The unit is 75 over 90 multiplied by 11,700. What do you have here?
9,750.
9,750.
You have converted percentage to number of units. That is your working one. Your working two. Now look at this cost. Direct material cost. Is it a variable cost, or a fixed cost, or a mixed cost?
Variable cost.
How do you know?
Because it changes with the level of activity.
Because
the number of material you use, the more your production is.
all right. To answer the question correctly, you are now going to test for cost behavior. To answer that question correctly, you are going to do test for cost behavior. You are going to take the cost to per unit. Let's go and test. So please, you must carry out a test first.
No.
This one, we can't hear
behavior.
you.
Hi, Chizaram. So, I'm not really sure what exactly to say, but then how I understand this thing, like the way I think it works is, normally, for you to get your marginal cost is like an addition of the whole variable cost, right? And for you to get your variable costs, take for instance, direct material. So you're supposed to multiply outputs in units times the variable costs per unit. Do you get? So for direct material, the outputs as the proposed level times the variable cost per unit for that particular variable cost. That is the direct material we're talking about. So say we have direct material, direct labor, variable production overhead. When you calculate
All
okay.
right, let me have my class. I said, before you can conclude that material cost is a variable cost, or before you can conclude that you are going to take that cost to per unit, like what we have here now. Test for activity level as given for Apapa factory, 80%, network unstable. For Apapa factory, 80%, 90%, 100%. Output in units, 10,400 units, 11,700, 13,000. Now go and pick material cost. Please check the question. For Apapa factory, what do you have here? That means you don't have the question open.
72,800 for 80%.
800.
72,
800.
thank you. For 90%, how much?
81,900.
For 100%, how much?
91,000.
91,000.
91,000.
Now, let us take the cost to per unit. We produce 10,400. Total material cost, 72,800. What is material cost per unit? 72,800 divided by 10,400. What do you have here?
7 naira.
7 naira. Check this out. 81,900 divided by 11,700.
7 naira.
7 naira. Check this out. 91,000 divided by 13,000.
7 naira.
Can you see it? For a cost to be variable, the cost per unit must be constant. For a cost to be a variable cost, that cost per unit must be the same. Look at this. As production volume increases, total material cost increase, but material cost per unit remain the same. Can you see it? Hello.
Sir, please come again for this material cost per unit. How you calculated it?
Are you there, Sandra? 72,800 divided by 10,400. What do you have? You can unmute. When you are done, come here. 81,900 divided by 11,700. What do you have? Check. 91,000 divided by 13,000. What do you have? You observe that as the production volume increase, you increase from 10,400 to 11,700. Total material cost increased, but material cost per unit is the same. This shows that direct material cost is a variable cost. This is an indication that direct material cost, this cost, direct material cost is a variable cost. Is that clear, please? Material cost per unit is 7 naira. At the new proposed level for Apapa, proposed new level 75%. The volume is 9,750 units. What is direct material cost? Direct material cost is equal to 9,750 units multiplied by material cost per unit 7 naira. That will give you direct material cost at the new proposed level 75%. If you work this out, give us the answer.
68,250.
You now go to your statements.
68,250, not 58.
Oh, 68. You go to your statements. Come here. Look at it. 75%. This is equal to 9,750 units. Under your variable cost, this is 68,250. You are done with material cost. You now go to direct labor cost. Go and text. Test for cost behavior. Direct labor. Activity level 80, 90, 100. Output in units 10,400 units. 11,700 units. 13,000 units. Now check the question. For Papa, what is total direct labor cost at 80%?
Total direct labor cost 62,400.
62,400.
No,
60. 62,400.
400. Yeah.
Yes.
Next,
70,200.
70,200. Next,
78,000.
78,000.
now get labor cost per unit. 62,400 divided by 10,400. How much do you have here?
6 naira.
6 naira. Divide. 7,200 divided by 11,700.
700.
6 naira.
6 naira. Divide. 78,000 divided by 13,000.
6 naira.
6
What can you see here? What can you see here? Labor cost per unit is the same. 6 naira, 6 naira, 6 naira. When we produce 80%, labor cost per unit, 6 naira. When we produce 90%, labor cost per unit, 6 naira. When we produce 100%, labor cost per unit, 6 naira. What type of cost is this?
Variable cost.
Variable cost.
Variable cost. You observe that as volume increases, total labor cost increase, but labor cost per unit is constant. In that case, direct labor cost is a variable cost. Direct labor cost is a variable cost. Now, go to the new level. Proposed new level, 75%. We are going to produce 9,750 units. Labor cost per unit, 6 naira. Therefore, total labor cost, total direct labor cost is equal to 9,750 multiplied by 6 naira. What do you have, please?
58,500.
68.
58,500.
58,500. You go back to your statement. $58,500. You have resolved direct labor cost. You now go to next. Production overhead. Let us go and text. This is 10,400 units, 11,700 units, 13,000 units. Please, what is production overhead at 80%? for Apapa factory?
59,200.
59,200.
59,200. Next.
63,100.
63,100.
Next.
67,000.
Now take it to variable overhead cost per unit. Divide. 59,200 divided by 10,400. Leave your answer in 2 decimal places.
5.69.
5 naira 69 kobo. Next.
5.39.
5 naira 39 kobo. Next.
5.15.
5 naira 15 kobo. What can you say? The overhead cost per unit falls as production increases. Can you see that? Hello.
Yes. As production increases, the prices reduces.
Thank you. As volume increases, total production overhead increase, but overhead cost per unit falls. Just 1 minute. I'll require this space. You observe that as your volume of production increase, total production overhead costs also increase, but overhead cost per unit falls. This is an indication that the overhead cost is a mixed cost. I'll take that again. I'm going to take that again. Let me take that again. When your production volume increases and total overhead costs also increase, but cost per unit falls, this is an indication that that cost is a mixed cost. Look at it here. As production volume increases, total production overhead also increase, but overhead costs per unit falls. This is an indication that the production overhead just 1 minute. Let me write these notes here so that when you are looking at the video, I will still require more space. I shall require more space. So, let's go to it. Okay. This is an indication that the production overhead is a fixed cost. It contains variable production overhead and fixed production overhead. That production overhead cost, it contains elements of variable overhead and fixed overhead. That means we must separate it. We need to separate the overhead cost into variable overhead cost and fixed overhead cost. How can we separate it? What method can we use to separate it?
We can use high and low method, sir.
Thank you. We can use high and low method. There is a question on the platform. Is it possible that as volume increase, overhead cost per unit also increase? That would be abnormal. That would be abnormal. So let's go to this quickly. Now we are going to separate the cost using high and low method. Now say separate using high, low method. Now do like this: high, low, output, production overhead. Go back. The highest level is 100%. Output is 13,000. Remember the steps. Select the highest output level and the corresponding cost. The highest output level is 13,000 units. The corresponding overhead cost, 67,000. Pick this. $13,000 units. Corresponding overhead cost, 67,000. The lowest level, 80%, 10,400. Corresponding overhead cost, 59,200. That is step 2. 10,400. 59,200. Now look for the differences. Differences in output. 13,000 minus 10,4. 2,600. Differences in cost. What do you have?
$7,800.
7,800. You have treated step 1 and 2. Next, calculate variable overhead per unit. I'm trying to get space there. Once you have gotten step 1 and 2, now calculate variable overhead per unit. Variable overhead cost per unit is equal to differences in overhead cost, 7,800, divided by differences in output level, 2,600. What do you have
It's
here?
3
Naira.
Naira. You have gotten variable overhead cost per unit. Now calculate total variable overhead, either at the highest level or at the lowest level. Calculate total variable overhead, either at the highest level or the lowest level. Now come here. At high level, total variable overhead is equal to, look at high level. We produce 13,000 units. 13,000 units multiplied by 3 naira per unit. That means total overhead is variable overhead 39,000. Now go back. Look at here. At high level, total overhead is 67,000. Out of this 67,000, 39,000 is variable overhead. What is the fixed overhead? This 67,000 contains variable overhead and fixed overhead. If total variable overhead is 39,000, what is total fixed overhead?
28,000.
Thank you. Total fixed overhead is equal to 67,000 minus 39,000. That will give you 28,000. You have separated the cost into variable overhead cost and total fixed overhead cost. You can now return here. At the proposed level, we are going to variable production overhead. We are going to produce 9,750 units. Variable overhead per unit multiplied by 3 naira. What is total variable overhead at the new level?
That's 29,250.
29,250.
29,250. You can see, we said marginal cost, addition of all the variable costs. That means direct material cost is a variable cost. Direct labor cost is a variable cost. Variable production overhead is a variable cost. If you add these three together, that will give you the expected marginal cost. So you should have
156,000.
156,000. You have gotten your expected marginal cost at the proposed level of 75% in Apapa. We now need to get the contribution. That means we need to get the sales value. Sales value. We are going to produce 9,750 units. What is the selling price at Apapa factory? You are giving the sales value at 80%, at 90%, at 100%. So calculate selling price per unit. Come here. Selling price per unit. Output here, 10,400. Volume here, 11,700. 13,000. What is the sales value here? 208,000. Is that not? What is the sales value here? Please check.
234. 234.
234,000. What is the sales value here?
260. 260.
260,000.
Zero, zero, zero. Now get selling price per unit. Sales value divided by output.
20
20
naira.
naira. 20 naira.
20.
Naira per unit.
20.
Next. 20 naira per unit. Next.
20 naira.
That means selling price of the product at Apapa is 20 naira per unit. You can now return here. If we produce 9,750 and sell 9,750 at 20 naira per unit, what are our sales value here?
195,000.
195,000. Contribution, sales value
Minus.
all the variable costs. What do you have here?
39,000.
39,000.
Yeah.
Your profit, contribution minus fees cost. What is the fees overhead cost?
28,000.
28,000. What's your profit?
1,000.
11,000.
Yes.
You are done with Apapa factory. You have produced a statement of expected marginal cost, contribution, and profit at Apapa factory for the new level, 75% level of activity. If the factory reduce production to 75%, total marginal cost to be incurred, 167,000. Total contribution to be achieved, 39,000. Total profit to be achieved, 11,000. We have used this information to predict what will be the cost, what will be the contribution. We have used cost, historical cost at Apapa factory to predict expected cost at the new proposed level of 75%. We are done with Apapa factory, but we still have Ikeja factory. We shall stop here. Yes, somebody's. Any question?
Yes, sir. Sir, assuming we are to use a marginal costing approach where we're not supposed to include fixed cost, how do we realize at our profit, since to get profits here now is contribution minus fixed cost to get profits? How do we realize at profits while using marginal costing approach?
Okay, first let me correct one thing. If you are using marginal costing approach, it doesn't mean you are not going to bring in fixed cost. So it only means that fixed cost is not part of your cost of production. Hello. If you are preparing marginal costing statement, it does not mean that you are not going to include fixed cost. It only means that your production cost will only include variable cost. What we have prepared here is marginal costing statement. What we prepare here technically is marginal costing statement. Marginal costing statement will produce contribution. For your contribution, you now lay the fixed cost. Under the marginal costing system, you are going to separate variable cost of production from fixed cost. That is the concept of marginal costing system. But under absorption costing system, we don't separate variable costs from fixed costs. All costs are included. Both the fixed costs and the variable costs are included as part of the cost of production. So please, don't say marginal costing statement. We don't include fixed costs. Your marginal costing statement will separate fixed costs from variable costs. For your marginal costing system, you are going to first derive contribution. When you are done with the contribution, you now deduct the fixed cost for the contribution so as to get the profits. Is that better, please?
Yes, sir. Thank you.
All right. You are encouraged to look at Ikeja factory. The question is not over, but we have to stop here. If you have enough time, or try to create time, attempt Ikeja factory. When we meet next week by God's grace, we shall complete the question. All right, thank you for your time. I will be checking out.
Thank you, sir.
May God give us a better understanding. Good night.
Thank you, sir.
Good night.
Good night, sir.